William O'Donnell. He's head of U.S. Treasury strategy at RBS Securities. He's joining us from Stamford, Connecticut. So, Bill, welcome. As we just heard from Brian, demand for this 5-year auction relatively strong. What are your thoughts?
Boy, I'll tell you, that's stunning. And to the, I think Brian mentioned we had a 2.81 times bid to cover for this auction. That's the measure that I think is the most accurate measure of where the support for this auction comes. And by my notes, that is the highest bid to cover seen since the September 2007 auction. I find the results extremely impressive because volumes in the Treasury market have generally been declining in recent weeks because of seasonal issues with dealer balance sheet contraction and investors sort of booking gains and getting ready for next year. So the fact that investors stepped up for this 5-year, I think, has to bring a big smile on the face of the U.S. Treasury.
And Bill, why do you think that there was such demand? I mean, what accounts for it?
Well, without a doubt, what we've seen in recent months is a major step up of foreign purchases of 5-year notes. Since June, foreign investors have taken down roughly 37% of all of the 5-year auctions, and that compares to an average for 2008 of around 19%. So they've really stepped up the pace of 5-year note auction awards. And I think what they like is the fact that the 5-year is just a critical sort of central point of the yield curve, where they get a fair amount of rate, certainly a lot more than 2-year yields, without taking on a huge amount of duration risk. So that it is without a doubt a much desired benchmark, and that showed clear today.
Bill, there's a lot of negativity, a little small negative minority interest out there, whether they think that this increase in supply every single week, when is the Treasury not going to be able to get away with it? In your opinion, what is the #1 catalyst that's going to bring the bond vigilantes back to the market and drive up interest rates? I know your long-term forecast is for higher rates. So what is the #1 catalyst for that?
Well, the #1 catalyst was identified in early November by Peter Orszag of OMB. And during a speech, he mentioned at that time that basically for now the Treasury supply is the only game in town because private credit flows have slowed so significantly. So overall, total market borrowing has actually been declining as a share of GDP. Public borrowing has increased significantly, but private borrowing has collapsed. So when private issuers come back to the market, then we're going to see a potential crowding out of investors that should force rates up.
Well, what is going to make these private borrowers? I mean, it's sort of what's going to be the catalyst for that catalyst? What would bring these private borrowers back to market?
Well, that's the trillion-dollar question. I think if we look back to the Great Depression, it took years for the private credit markets to come back to some normal functioning. Here in the Great Recession, it may take some time. There are clearly still issues with households, and household credit demands have been falling. There are clearly still issues in the banking system highlighted by recent Fed speeches. And so it may take some time. And so for the time being, you know, the demand is clearly there for Treasuries, and that's a good thing for taxpayers.
All right, unfortunately, we're out of time. Bill O'Donnell of RBS Securities, thanks a lot for giving us the reaction to that latest record auction. Thanks a lot.
Thank you.